Welcome to Know More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Hello, everyone. Good morning to those of you joining from the US. Good afternoon to our friends and colleagues in London and Europe. Happy July 1st. Rabbit to those who celebrate. My name's Winnie Cisar. I'm the Global Head of Strategy at CreditSights. And I feel like truly a broken record, but what a year it has been. Despite a truly chaotic slew of headlines over the course of this year, credit markets, really risk markets, closed off June on pretty strong footing. US IG ended at 76 basis points. That's 3 basis points tighter year to date, while high yield is 6 basis points tighter at 275. Now, of course, the real story has been in rates, perhaps the real yield, as IG and high yield yields are a whopping 37 and 52 basis points higher year to date, respectively. Of course, that misses the story in equities, where the S&P 500 is up 9.6% and up 18% from the March lows. As we worked on our second half 26 and first half 27 preliminary outlook, we were really balancing a lot of moving pieces. We have to acknowledge the reality of higher recent inflation prints and some good job market momentum, ample cash on the sidelines, and a Fed with a new leader aiming to refocus on inflation. From the first events of the first half of the year, it seems like risk markets can really only go up. Elevated yields underpin a lot of cash generation from money market funds, and AI generally continues to fuel optimism despite some pullbacks here and there. However, we're then faced with the reality that credit markets are trading at very tight spreads. That leaves little room for error across the market, or even just a handful of key issuers, as the CCC sector seems to know very well. As we look at returns for the year, 64 basis points of IG excess return is not too shabby, but 1.9% of high yield total return is fine, but perhaps not the type of home run one would expect given the broader strength in financial markets. Today, I'm joined by Zachary Griffiths, head of U.S. investment grade and macro strategy, and Logan Miller, head of Euro strategy, to discuss what all of these moving pieces mean, our expectations for the second half of 2026, what to worry about over the next 12 months, and how we are thinking about starting 2027. Now, July is going to be an action-packed month. We're already kind of starting off on a little bit rockier footing, with markets taking a bit of a leg lower. We, of course, have the pending nuptials of Taylor Swift and Travis Kelce, and we're all going to be celebrating the U.S. semi-quincentennial, which is difficult to say, but, what an exciting time. Now, as always, if you have questions for us, you can submit those using the Q&A chat box. And of course, check out the outlook reports that we put out overnight. We have the US and Asia outlooks out alongside sector strategy and snapshots. Logan will be coming out with Europe tonight, and we'll also be publishing EM outlooks shortly. Now, as usual, we would like to kick this off with an audience question, perhaps very timely, given that Kevin Warsh is speaking this morning in Portugal. I wish I was there. And the question is, with the Warsh Fed signaling a more hawkish message while also conducting many policy task forces, what do you think will be the Fed's path over the next 12 months? Are you expecting an extended hold, Fed funds unchanged, a modest tightening cycle of 1 to 2 25 basis point rate hikes, an aggressive tightening cycle of 4 or more rate hikes, a modest easing cycle, 1 to 2 rate cuts, or an aggressive, oh, this is supposed to say easing cycle. Oh, well, an aggressive easing cycle should be E of 4 or more rate cuts. I'll go ahead and let everybody vote. We actually have a number of responses already. And let's see what the survey says. I'm waiting with bated breath. Okay. All right. An extended Fed hold, Fed funds unchanged is the majority of the audience, followed by a modest tightening cycle. We have very few doves in the audience. Zach, what do you make of this? If the audience is expecting an extended Fed hold, do you agree with that? And how do you expect the policy to unfold over the next 6 to 12 months? How will that impact US Treasuries?
Thanks, Winnie. I'd say this is surprisingly unsurprising. Is that a thing people say? I'd say from our perspective, as our loyal readers and listeners may recall, we came into the year expecting as many as 3 rate cuts in 2026 on the basis of a weaker and coming into the year already weak labor market. The big shift that we've had or seen, at least in the data, is a stronger labor market and a stabilization there. So we have shifted to an extended hold. We agree with the audience, thinking that the Fed is on hold through year end and perhaps all the way through the first half of 2027. A modest tightening cycle I see here around 35%. That's certainly what the market is priced for. And I think one of my big takeaways from market resilience, at least more recently or following Fed Chair Warsh's first meeting, is I think 1 to 2 hikes would be fine for the market. And, that's kind of what's priced in now. It's not causing really any meaningful consternation in equities. And I think that elevated yield environment, while obviously causing some total return losses depending on your entry point, is not a huge concern in credit, at least in the investment grade world. I think Winnie will certainly get into some of the bifurcation that we're seeing in the leverage finance space. And I think that gets more interesting considering the impact of those 1 to 2 hikes down the rating spectrum in the high yield space. So if we're correct that the Fed is in fact on hold and not hiking at any point in the near future, we think that rates could come down a touch from spot levels, but not as much as we had anticipated even just a couple of months ago with our second quarter outlook. And so we are looking for the 10-year yield to move a little bit lower, around 4.25 at the end of the first half of 2027, with the 2-10s curve steepening just a touch to around 38 basis points from, I'd say, I guess we've steepened a bit today, but call it 30 basis points coming into today. So we are still a little bit more dovish than the market. We've gotten less constructive on duration, have really shifted more to an overall neutral view, thinking there's probably still some price return to be eked out from current levels, but not as meaningful as we had anticipated. And the big shift there is a change in our view or assessment of kind of the labor market as it stands today and the likely path forward as more stable than weakening. And I think that's clearly how the Fed is thinking about the labor market, even just listening to Fed Chair Kevin Warsh now. They see it as solid and stable economic activity remaining resilient. And so I think some of these sensitivities we had expected coming into this year have been more resilient, and that's reflected in this updated outlook.
All right, more resilient. It's definitely been a big theme of resiliency. Zach, we have a question from the audience that I think is relevant to the Fed, and that is, what are the likely impacts and risks of the Fed trying to manage rates by running off their balance sheet?
I think it's a fair question, probably not one that is terribly important in the very near term, as the Fed is adding 10 billion per month and could even be ramping that up later this year. If we were to see a major shift in the balance sheet toward runoff, I think that's going to again have to come from the regulatory side in terms of adjusting policy so that banks' demand for reserves comes down. And so when I think about balance sheet policy going forward and its likely impact on Treasury yields and the shape of the curve, I think it's likely to be fairly limited. But if we were to see a more meaningful runoff in the securities portfolio relative to where we are today, I think that pushes yields higher. Maybe not so much of a steepening move, but definitely higher impulse, especially when you consider the fact that quantitative tightening has ended, and that's actually reduced the amount of supply for the market to digest in 2026. So it'd be a big reversal, but not something that we're expecting anytime too soon.
All right, fair enough. So I want to dig into the macro a little bit. We had ADP payrolls this morning. They came in a little lighter than expectations. We had some ISM manufacturing data, which I would say was pretty good overall. Zach, can you talk about some of the factors that have supported this better than expected macro environment to start 2026, especially amid all the energy and commodity price volatility? And do you think that these conditions are likely to persist?
Yeah, as I kind of alluded to just now, Winnie, the labor market has been key. We've added just shy of 570,000 new jobs in 2026 alone. That compares to just 116,000 in all of 2025 after the annual revisions. And I think importantly, if you look at what we're seeing from the establishment survey over the past couple of months relative to the quarterly census of employment and wages, which is what drives those annual revisions, they're tracking much more closely. So at least so far, we're not tracking toward another year of huge annual revisions. And maybe we can take this 570,000 new jobs more at face value than what we could have with the 2025 numbers up until this point. So I think a resilient labor market in terms of job gains becoming much more positive than they were last year. Initial jobless claims really haven't moved at all. That's something that Winnie and I talk about here in the office quite a bit. I think that kind of supports a resilient backdrop. And even some of these survey numbers from ISM on the manufacturing side, which had historically been quite weak, have moved more into positive territory. And when we look at what that's meant for the consumer, you can see on the top left chart here that even on an inflation adjusted basis, so accounting for the big increase in spending at the pump, we've had retail sales accelerating from the trough around the end of 2025. I think a lot of that is being driven by the upper end of the K-shaped economy. And I heard on Bloomberg this morning that the top 10% of US households in terms of discretionary spending do as much as the bottom 70%. And so I think that this idea of a K-shaped economy, we had thought that would create more of a fragile economic backdrop, but it seems like that this dynamic could persist for perhaps longer than we had anticipated. Now, sentiment remains very weak. You can see in the top right there, our aggregate measure of sentiment, that's on the right axis, inverted, has risen. Meanwhile, you haven't seen a meaningful move in spreads at all. So sentiment remains soft. You can kind of see the analysis that we do between the soft and hard economic data and the bottom two charts. That gap remains notably wide, but if anything, the hard data measure has accelerated. You'd have to squint a little bit on that longer term chart. But we see a strong labor market supporting resilient economic activity, probably driven more so by the upper end of the K. But from what we've seen so far, that doesn't necessarily produce immediate term fragilities in the economy that leave us too worried. And so that is another big contributor to kind of our more stable environment for financial markets and less cautious view as we think about at least the next 6 months. Obviously, a lot of uncertainty over the next 12 months. And I think the midterm elections will be a key item to keep an eye on from a calendar perspective in terms of a potential shift. But we've got quite some time before we get there. And so shifting more into this carry type of environment over the next several months, Winnie. So I want to go to bring Logan in here and get a sense of the euro interest rate market. So Logan, before we go to you, I want to ask the audience, the euro OIS markets currently price another 25 basis point rate hike by year end. Do you think this pricing is too hawkish? So the ECB will remain on hold. Too hawkish, the ECB will need to shift to cuts. Too dovish, ECB will hike by more than 25 basis points this year, or just about right? guess I could have done maybe a Goldilocks type spin on that one. But all right, we got a few answers coming in here. I'm going to wait just another minute or so.
Zach, while we're waiting for the audience, we can talk a little bit about some of the different cash flows. We have a question from the audience around, have you seen evidence of assets moving from money markets to credit markets in the US? And how do you understand the different trends in flows between high yield active funds and ETF in Europe and the US? Do you want to take the first part with money market funds and credit markets? Because I know there's been a lot of action there on the IG side, and then I can take the high yield.
Yeah, I'd say perhaps not evidence of moving from money markets to credit markets, but I'd say the interest earned on money markets seems to be flowing into various parts of the financial markets, certainly including USIG. Winnie and I were just talking before the call. I think we've had just shy of 200 billion of inflows into IG ETFs and mutual funds this year, and we project that money market mutual funds will throw off another around 300 billion in interest this year. So not even needing to see a rotation out of money markets, but taking that interest earned and putting it other places, that's certainly benefiting the IG markets. Winnie, I'll turn it to you for LevFin.
Yeah, for sure. I think that within the LevFin space, we have seen some differentiation in terms of retail demand and fund flows. IG has been a tremendous beneficiary, as Zach said, of that interest being earned on money market funds. Whereas in the LevFin space, it's very clear that there's still a strong institutional bid for yield, and that we're seeing ETFs still see pretty solid demand. And ETFs do tend to be kind of a proxy for institutional demand, given that a lot of big asset managers use these as kind of liquidity sleeves, whereas the active high yield mutual funds and broadly syndicated loan funds have had net outflows. And we do think that that is indicative of some broad-based kind of retail concern around a potential for pullback, or alternatively, just a preference for moving into equities, where it seems that the upside is a little bit more robust in an inflationary kind of AI-driven environment. So from a fund flow perspective, you're seeing very bifurcated demand that is very much aligned with up in quality yield and inflation protection, as CLOs are also posting pretty strong inflows to start the year. All right, Zach, back to you on the ECB.
Thanks, Winnie. So the audience thinks that market pricing is too hawkish and the ECB will also be on hold, with just a touch below that, thinking that what's priced in the market is just right. So Logan, the ECB is now officially ahead of the Fed and hiked rates by 25 basis points. What do you make of the hawkish ECB bias, and what is your view of the Eurozone macroeconomic fundamentals as they stand today?
Yep. Thank you, Zach. Yeah, so I guess I'll start actually with the macroeconomic picture and then sort of tie that into our views on the ECB and policy rates. But, by and large, I think, Europe has continued to show resolve in the face of another major exogenous shock. It seems like every year since I've joined CreditSights, there's some big event that transpires. But credit markets have seemingly shrugged off some of the bigger picture risks. And I'll get into kind of what the themes that are driving that. But, I think a few things that we highlighted in our second quarter outlook actually still hold as it relates to the energy situation and the impact on Europe. That's clearly been the biggest driver of sort of expectations for policy tightening, as well as the moves we've seen in the sovereign rate markets. First, like I mentioned in our outlook last time, the recent increase in energy prices really does pale in comparison to 2022. We've seen kind of an initial surge in nat gas and power prices in Europe, but that's since come down in a pretty significant manner over the last 2.5 months. The second point that sort of differentiates the current situation with 4 years ago is that inflation heading into 2022 was on the rise prior to an energy shock amid sort of pent-up demand and ultra low interest rates. Ahead of the Iran conflict, Europe had already been facing kind of a broader deterioration in the growth outlook from U.S. tariffs. We've seen slowing export growth and supply chain disruptions continue, which in our view has meant that domestic demand was unlikely to really push
core inflation sharply higher, which was the key kind of risk going into the Iran conflict. And then the third thing is that the fiscal response that we've seen to the current situation has been much more limited versus 2022. And why is that? One, the key driver there is really fiscal budget deficits in several key European countries, namely, France and Italy are high by historical standards. So that meant that government borrowing costs are near multi-decade highs, and so the appetite for sort of further fiscal stimulus has been quite limited. And really, the fiscal impulse in terms of the read-through on inflation has been negligible at this point. So I think those three kind of key differences really, have held true over the last several months. Fears over a material energy shock have largely subsided, and I think we're sort of positioned for what will be a kind of a slow recovery in the second half of 2027 as it relates to economic growth. So from sort of a policy perspective, so far it's really been inflation concerns over growth concerns at this point, especially as it relates to what the ECB has done. They hiked rates in June by 25 basis points for the first time in nearly 3 years. We continue to say that was more of a kind of an insurance hike in the wake of higher energy costs, but that it would be probably temporary. And so, as you mentioned, Zach, rates markets are sort of priced in for maybe another 25 basis points hikes later this year. I think that would particularly happen if the Fed does move. I think a lot does depend on actually what other central banks are doing, but it's certainly not a kind of predetermined outcome that we see another rate hike. Like I mentioned, energy is the key driver of inflation, and it was also the key driver of the rate shock back in 2022. We've seen that reverse in recent months, and I think that limits, the amount of policy tightening that we're going to see going forward. Today, euro area inflation data was certainly helpful to our sort of view for a more dovish stance on the ECB going forward. Headline inflation came down to 2.8%. Was expected to rise around 3%, and more importantly, core inflation was below consensus expectations at 2.4%, which is sort of in line with the trailing 12-month average. So I think important for the outlook is really that sensitivity to interest rates varies hugely on a country-by-country basis, and I'd even argue even more so at the kind of sector or industry level. And what we've seen so far in terms of economic growth is continued fragmentation and really varying degrees of demand destruction over the last few months. To that point, consumer demand has been generally subdued. We've seen weakness in discretionary spending as a result of higher consumer energy costs and other household items. We think that continues to push off large ticket price items by consumers towards everyday goods and staples items. And at the same time, we're seeing net exports, like I mentioned, which is really a key driver of GDP growth, remain a drag on Europe's economy more broadly due to trade headwinds and competition from cheaper Chinese goods sold globally. That's particularly sort of evident for the auto story. And then there's clearly continued subdued manufacturing PMIs across the region. That's really been the case for the better part of the last 5 years. And so as we're thinking about the direction of rates going forward, we would argue that the narrative could shift over the course of the second half of this year, and Europe could actually be looking at rate cuts as we get into 2027, at least from an expectation standpoint. While rate hikes were probably appropriate given sort of the conditions back in March and April, the reality is that growth continues to decouple from other regions, namely the U.S., and we would argue that lower policy rates are needed to really boost European competitiveness going forward. So, in short, we would continue to sort of fade the hawkish moves in European rates markets. We think that additional rate hikes by the ECB are unlikely in the context of a potential ceasefire agreement between Iran and the U.S. What's been a generally weaker economic backdrop for Europe since February, and then importantly, elevated long-term borrowing costs, which should continue to sort of gradually tighten financial conditions over time, and that implies, what we are looking for is a gradual decline in the term structure led by the front end over the next 12 months. So if our views materialize, and we'll talk about sort of our view on credit, but we do think that's going to be a supportive backdrop for credit spreads to really kind of remain in this tightly bound environment as investors are kind of pushed further out the curve and down the credit spectrum to sufficiently meet yield bogeys and generate positive real returns going forward.
Great, Logan. So on the topic of credit spreads, we would love to hear from the audience your view on what has played the biggest role in supporting corporate credit spreads this year. The first, is it technicals, just still too much cash in the system? Fundamentals, corporate earnings growth and credit metrics support tight valuations? Is it elevated yields? We have this demand for income generation that just underpins spreads. Or is it the AI FOMO? If you are having a fear of missing the AI trade, you are just sticking with the market. I will let our audience vote. And while I do, Zach, I'm going to kind of mash up two different audience questions, which seem to be kind of the different sides of the same coin. The first one is asking whether we think that some people are rotating into longer dated US Treasuries. And if not, what level would the 5 or 10-year need to hit in order to get investors rotating out the curve? And then the other side of this is, while we have macro data improving, that would indicate that we should go longer in duration. But we also have the reality that the US needs to refinance a lot of its debt in the next 12 to 18 months at much higher interest rates. Are we going to worry about US default risk? And should we go for shorter duration because of that? Zach, how do you make sense of all this?
There's a lot to unpack. I'd say thinking about Treasury's debt outstanding, to lump T-bills, which are all within 1 year of maturity, with coupon debt is not really the right way to think about it. So thinking about Treasury always rolling its T-bills, I think there's clearly demand there. As we already mentioned, money market mutual funds have nearly $8 trillion. I'm not too worried about that. In terms of attractive entry points for Treasury yields further out the curve and what we're seeing in fund flows, I'd say fund flows have been generally stronger in the front end and belly of the curve, and I'll need to kind of verify that, but going through our regular reporting on fund flows, that's the sense that I get. And we had previously thought yields around these levels were a decent entry point to extend duration. That's kind of before what we heard from the Fed and kind of a more hawkish shift. We see the balance of risk to the path of yields as much more evenly distributed than our prior, more constructive outlook. And part of that is not necessarily for a bad reason. If we went back a couple of slides, I have one looking at the change in Treasury yields based on real yields and break-even inflation expectations. And if you were really concerned about deficits and maybe what's going on with the war, you'd see more of that in break-evens, I think. And really what you see is real yields up as economic activity has remained resilient. So overall, we're still seeing fund flows into U.S. Treasuries, not terribly concerned about the next 12 months in terms of refinancing risk for Treasury, but as we look out to, say, the second half of 2027 and 2028, we are looking for supply to rise given growing maturity walls and kind of a continued deficit. So not so much over the next 12 months, but longer term, we think that's another factor that creates a more balanced set of risks for the path of yields from where we are today.
Great. Thanks, Zach. So let's see what the audience has to say around corporate credit spreads. And this is pretty evenly split. Actually, one of our audience members responded to me on this question saying, all of the above, which I don't disagree with. But the audience, about 1/3 is blaming technicals, probably related to that. We have another 32% blaming elevated yields. A good quarter of the audience say, hey, fundamentals are looking good, and AI FOMO is at the bottom of the list. Zach, if the audience is really pointing to technicals with some support from fundamentals, do you agree with this assessment? And then how are you thinking about that path of US IG spreads over the second half of this year, maybe into 2027?
I agree. Technicals, I think, are huge and something that we had previously put more emphasis on in prior outlooks and thought might shift more to the background this year. That hasn't been the case. I think I've kind of gone through all of the numbers on the fund flow side and the money market mutual funds that I wanted to. In terms of how it impacts spreads going forward, I think one of the things that we've been focused on is, of course, this heavy supply from tech issuers and how that's remained relatively contained to the tech space. We have a chart that we can go through later on in the deck showing just how cheap tech now screens to its historical norms given this this borrowing binge. But for now, we think that hyperscalers are probably more or less on the sidelines through the end of the year. So some of that technical headwind should fade. We are looking for a downshift in issuance in the second half of the year, but are looking for a record year of issuance still at around 1.9 trillion in US IG. And so thinking about the environment that we've been in and whether or not it will remain supportive of the credit markets, I think it should. And I think that technical support of, call it 300 billion per year in interest earned on money market mutual funds, acts effectively as a 1% of GDP fiscal transfer or fiscal stimulus from the government to financial markets. And I think that's been part of what's driven robust capital markets and a still robust US consumer, particularly at the top end of the earnings or income distribution.
Great, thanks, Zach. So as a follow-up to that, if we're still, feeling pretty comfortable just in general with kind of the spread product and direction of spreads, how do you think about credit and curve strategy in the second half of the year? Are there any places that are really attractive in terms of attracting carry? And also, are there any places in the IG market where spreads could continue to tighten?
Yeah, so this is that chart in the middle here looking at how sectors are trading relative to their historical spreads to the index. Tech has kind of blown out. In terms of where we prefer positioning, coming into the year, we had favored an up in quality and shorter in duration for excess return focused investors as we looked for spread decompression, given our prior expectation for much wider spreads than where we are today. Now, given some of the factors that we've already discussed on this call, I'd say we prefer more of a bullet portfolio in US IG focused around the kind of the longer end of the belly in the 7 to 10 year space. You can see on the table in the top right, it trades more or less fair to its historical norm, but offers about 17 basis points of pickup. I think we're comfortable going there and kind of earning that carry, at least in the near term, instead of trying to keep it shorter in duration and protect against large spread widening moves in the near term. And that applies to our ratings positioning recommendation. Now, triple Bs look quite rich as opposed to 7 to 10 year space, which looks more fair. But again, that's really the only area that you can add carry. And we think that that's kind of the environment we'll be in. I'll refer our listeners to our IG Best Ideas report that we put out in May in terms of kind of picking your spots. I do think credit selection is still important in the triple B space. And as you'll see in our outlook piece that we published overnight, there is a growing list of potential fallen angels. So we don't want to say that fundamentals are a complete non-factor, but we definitely prefer to focus on carry in the near term as opposed to that more defensive positioning we had previously recommended. In terms of sector strategy, we are kind of still overweight or outperform some of the less cyclical sectors like telecom and transports. We did upgrade IG Tech to an outperform on these cheaper spreads, and this kind of more stable outlook, at least in the near term from an issuance perspective. I think Jordan's outperform on Oracle and the performance we're seeing there has kind of contributed to our relative comfort in the IG space as a whole. So that's kind of how we are thinking about the IG market as it stands today. Winnie, how do your views for LevFin compare to kind of what I'm thinking on the US IG side? Do you think stable Fed policy is enough to support the loan market in particular?
This is a great question, Zach. And I would say that we have some kind of mixed views on the LevFin market. Overall, I would say we're still kind of cautious. There has definitely been a clear bifurcation this year between the lower rated cohorts, and that's true in both the high yield and the broadly syndicated loan market. As we think about triple Cs, one would expect them to be massively outperforming if the S&P 500 is up almost 10%. But they've been the worst performer year to date in both bonds and loans, and that extends some pretty nice, nasty price action that we saw last year. So it's kind of hard to say what exactly would get that dynamic to change, which would really be what you need to see to feel comfortable adding a lot of risk in the high yield market or in the broadly syndicated loan market. We think that a lot of the problems plaguing these lower rated issuers are related to the elevated base rates and some additional issues just from over leveraged capital structures, a lack of kind of sponsor backed M&A activity, and then some operational headwinds, of course. As we think about the LevFin landscape and where to position for the next 12 months, we do continue to favor bonds over loans. We think that that benefit from the Fed being on hold for inflation protected loans is somewhat outweighed by the reality that we have a loan space with more challenged fundamentals. And that also we do have some 2028 maturities, which will become next year's business for some stressed and storied issuers, especially in the software sector or the services sector. And that means that bonds just looks a little bit more fundamentally sound at this point. I think within LevFin, an up in quality strategy is still kind of the best bet, though when we think about double B and single B spread levels, they're very compressed relative to historics. In fact, triple Cs right now are actually trading a bit wide of the long-term medium on a spread perspective. But like I said, it's kind of difficult to understand what exactly would cause that to shift overall. I think within LevFin, you have to align with that single name catalyst driven activity. And with that, we are recalibrating our sector strategies just a little bit, downgrading high yield energy back to underweight. We had been overweight. We saw a really strong first half 2026 performance, and that has left high yield energy spreads sub 200 basis points and a bit vulnerable to any sort of recalibration as energy commodity prices leg lower and the US Iran peace deal presumably moves forward. We also upgraded high yield autos to market perform. We see pretty good supplier profitability outlooks, and our analyst team, led by Todd Duvik, has a constructive view on Goodyear Tire. Finally, within LevFin, I'd note that we're holding our LevFin issuance forecast steady at $250 billion for high yield and $375 billion for BSL. That is net of pure repricing and extension activity. Year-to-date issuance indicates that I would say we're slightly ahead of that from a runway perspective. However, I don't think that we would be surprised to see a little bit of a slowdown in the back half of the year. We've seen a lot of proactive refi already this year and last year and 2024, and we are not expecting that borrowing costs are going to really come down in the near term, putting a little bit of a deceleration in that pace of activity. So Logan, let's go next to the Euro markets. Euro corporate credit has performed quite strongly this year, despite more reliance on energy imports and the ECB already starting a rate hiking cycle, or just at least a rate hike. What do you make of Euro IG spreads that are effectively in line with the US and Euro high yield spreads that are actually tight to US levels? Are these relationships going to hold?
Yeah, Winnie. If I was putting together a fixed income portfolio and kind of disregarded how we got to current valuations, based on the charts on the screen, I probably would not be buying corporate bonds. We're seeing spreads basically at or towards the kind of cycle tights, not a lot of incremental gains potentially from owning spread products. But of course, that's not how the bond markets work, and we're not advocating for outright selling of corporate bonds. But I think, in terms of how we got here, the key linchpin in our view has been that primary market activity in Europe never really gave way to cautious sentiment in the secondary markets. One of the largest IG deals in the Euro market, priced on record, was actually in the midst of kind of peak volatility earlier this year. So in other words, it's really boiled down to steadfast liquidity being provided to European corporates, which has kept the lights on for credit markets. That's enabled both IG and high yield corporates to shore up their balance sheets, boost their liquidity positions, and also fend off the fundamental erosion from what's been kind of a difficult operating environment. Additionally, we saw with Q1 earnings, results came in broadly, higher than expected. There are obviously some notable exceptions there, but in general, the earnings backdrop is holding up, and consensus forecasts for the remainder of 2026 are solidly positive. Despite some choppiness to round out the second quarter, Euro IG spreads have clawed back the widening in March and are nearly back to the cycle tights, like I mentioned, at 78 basis points on the IG index. That's just 7 basis points off of the wides hit earlier this year. And that's left year-to-date excess returns well in positive territory, all while we've seen a decline in bond yields, government bond yields, boosting total return performance across the credit spectrum. In our view, and I was talking to Zach earlier about this, but it's just been remarkable that spreads are basically unchanged on the year despite all of the ups and downs that we've seen as it relates to the Iran war, private credit, AI, you can name it, spreads are effectively unchanged. And so I think that really underscores our view for limited room for further spread compression from these levels. Now, of course, we could see maybe 5 to 10 basis points of kind of a grind tighter on IG, but then you're running up against sort of just fixed income math where, spreads can just not, they would have to, something has to give there for spreads to continue to kind of move tighter. But I think more important for the outlook is, that elevated corporate bond yields by historical standards should and probably will keep a lid on meaningful spread volatility in the next 6 to 12 months. We've seen total return and foreign investors remain keen to add exposure to high quality duration in the Euro market. And I think that's going to provide a particularly strong backstop for Euro IG spreads going forward. So heading into the second half of this year, we're expecting to see range bound spreads in the very near term, kind of a summer of carry, if you want to call it that, as really the strong technicals persist and credit fundamentals remain overshadowed by positive equity momentum. But then we expect to see, a bit of a pickup in credit volatility in the later part of this year, especially in the fourth quarter, due to what's typically a very heavy post-summer calendar for fixed income supply. And as I alluded to earlier, very lofty earnings growth expectations that are really kind of baked into risk asset valuations at this point. So, despite kind of our more sanguine view on spreads overall, we are looking for an increase in dispersion in the second half at both the sector and issuer levels. We think this is going to be driven by the lag effect of higher rates, some fading technicals caused by a crowding out from robust government debt supply, and then, of course, rapidly changing dynamics around AI and the read-through that has to equity valuations. So when as you mentioned on the beginning of this call, I think there's a little room for error. From a positioning standpoint, I think that means, trying to, be quite defensive at the sector level. I think trading cyclicals for defensives and moving up in quality in terms of credit selection is the best way to play the second half of this year, as we expect to see kind of range bound spreads going forward.
Great. Thank you, Logan, on that. I would love to know on the sterling side of things, as sterling yields are, pretty high relative to other IG asset classes, but spreads are, of course, quite tight there. Seems like they're just tight everywhere. Yeah. How are you thinking about the sterling market? Is there kind of room for outperformance if we're going to have a hot carry summer? Is that where we want to be?
Yeah, look, I think the sterling market is there are some unique characteristics that sort of differentiate that from Europe. One, it's a longer duration asset class with a lot of kind of legacy bonds outstanding that are held by pension and insurance companies. Flows from kind of those liability-driven investors tend to be pretty sticky. I would say that UK companies that issue in sterling are predominantly global in nature and not really acutely sensitive to the economic conditions in the UK, which remain kind of weak, I would add. They also have, really shifted their borrowing patterns away from the sterling market in recent years. The majority of UK issuer debt is actually in US dollars and euros. So that certainly kind of helps things from a technical perspective. If you're looking at it from sort of a scarcity value standpoint. And then, another major trend has just been kind of subdued growth in the sterling non-financial segment. Really over the past decade, we did a report on that, looking at sort of the key trends post-Brexit. Non-financials now make up less than 40% of sterling IG debt outstanding from around 60% 10 years ago. So really, again, there's limited opportunities for sterling investors to get exposure to non-banks. So I think that does help from a scarcity value standpoint, particularly further out the curve. So strong technicals, I'd say fundamentals are probably broadly in line with kind of what we're seeing in terms of global markets. But Winnie at 80 basis points, we're trading at, basically the tightest levels over the last 20 years. And importantly for IG investors is that excess return break-evens, which are kind of measured by spread over duration, are effectively at all-time lows. So not a lot of room for upside from a spread perspective. If you are owning sterling corporates, we would prefer, kind of the front end and the belly of the curve from a spread perspective. But overall, we would rather be owning more liquid gilts from a duration perspective, and kind of two things that stand out there. One is, I think fiscal consolidation is not being priced into the gilt market at all. We're going to see new leadership in the UK government that could come with some volatility, but the kind of high borrowing cost environment means there's not a lot of headroom for sweeping fiscal reform, and so we see the path for kind of long-term gilts as lower over the next 12 months. And then secondly, is just the positive convexity you get with gilts that are trading at really steep discounts to par. If you're a sterling-based investor, you know this, but there's a favorable tax advantage to owning gilts rather than corporates. So if you're going to play the sterling ag market from a duration perspective, we'd rather be owning gilts than corporates at these levels.
Great. Thank you, Logan, for that. All right, I'm going to set up this next audience question, which is over the next 12 months, which IG asset class will post the strongest excess returns, so outperforming US sovereigns, US IG, Euro IG, US agency MBS, EM IG sovereigns, EM IG corporates, or tax-exempt munis. While the audience is voting, Logan, I actually have a follow-up for you on some of your recommendations. Within the Euro market, do you have a preference for maturity and rating categories?
Yeah. So like I mentioned, spread curves are generally flat the further you go out. So in terms of kind of duration positioning within Europe and IG in particular, we would be favoring the kind of 3 to 6 year market. Curves are actually pretty steep there. You're actually not going to see a whole lot of new issue supply in that part of the market. So we think that does provide, a strong technical backdrop from a duration perspective. But the further out you go, similar to the sterling market, break evens are quite thin. So we would be kind of underweight, the 10 plus year segment of the Euro IG market. And then in terms of ratings, I think it's probably pretty bifurcated. It's going to be much more about, sector positioning within ratings more than anything else. And there's probably, some room to be moving up in quality in general. So I would probably favor single Bs over triple Bs, but that, probably that it's not a broad sweeping recommendation. For instance, we like, European telecom, which tends to be more triple B, but we think that's a good sector play from sort of a duration perspective, but not necessarily, kind of that, up in quality trade.
Great, thanks, Logan. Let's see what the audience has to say about their preferred IG asset class for the next 12 months. All right, a little bit all over the place, but EM IG corporates is the winner of this poll at exactly 1/3 of the audience, followed by US investment grade, and then tax-exempt munis. And then we have a very even split across Euro IG, US agency MBS, and EM IG sovereigns. I think that this is a great opportunity to highlight our global strategy team here at CreditSights. We're all working together to put together these coordinated outlooks. Zerlina Zhang, our head of Asia strategy in Singapore, released her second half 2026 APAC outlook overnight. She's maintaining a market weight allocation to Asia dollar denominated IG and high yield, with expectations that IG spreads trade sideways and well tight to US IG and high yield, while Asia high yield defaults are likely capped by some very strong local funding conditions, and they do have some alpha opportunities in the space. Regis Chatelier, our head of EM sovereign strategy, is still somewhat cautious on EM dollar-denominated sovereigns and IG and high yield, as valuations are now wound incredibly tight. EM high yield sovereigns trade inside of US high yield spreads, while EM IG is only 10 basis point wide of the US. And then finally, Eric Vega, our new head of EM corporate strategy, has been very, very busy launching coverage on a slew of LATAM credits. He somehow found the time to assign an underweight allocation to EM, dollar-denominated corporates, as he expects that the fundamental improvement that we've seen over the past few years has probably plateaued a bit, whereas valuations reflect a very sunny outlook. If you are interested in some of these global strategy views, Zerlina will be hosting Outlook webinar on Friday focused on Asia, while Regis, Eric, and Zerlina will host an EM Outlook next week on Thursday, July 9th. Registration for both of those webinars is available on the CreditSights event tab, or you can, of course, reach out to your CreditSights sales representative. All right, we have made it through a lot of the world of credit over the past 50 or so minutes, and we have one more question for the audience. We would not be good credit strategists if we didn't talk about risk in one way or another, and that is, what is the biggest risk to markets in the second half of 2026? Is it A, that the AI bubble bursts, labor market consumer weakness, sticky inflation, and central bank tightening, the US midterm elections, or something else? If you have something else, tell me what it is in the Q&A chat box. I am always interested to hear what people are thinking about and what they are worried about. Zach, while people are voting, we do have a question on the Fed, which could be maybe one of the risks for 2026. As the Fed is expected to provide less guidance, do you think that that is actually going to drive more market volatility?
I think it could drive less volatility, Winnie, actually. And even if you look at volatility over the past month, really even the first half of the year, we got a slide in the Outlook deck. The 10-year has traversed a 73 basis point range so far in the first half of 2026. That's about 0.7 standard deviations below the long-term norm. So while it has felt like a volatile environment, if you look at the move index, that's down, realized moves, and the range is relatively narrow. And I think eliminating this second derivative of looking at the data, having the market decide for itself what it means, and then having to think about what the Fed will think about it, and just have the market make its own distinction and have positioning and trading based on that opinion, I think it could reduce volatility in the long run. That's not to say that if Wars comes out and says they're nixing the SEP, I think that probably adds a dollop of near-term volatility, but he's certainly prepping us for substantial changes with these task forces.
Yeah, I will be very curious to see how much actually changes. I mean, I've seen a lot of task forces in my days of being a corporate employee, and the more you task force, the more things stay the same. So let's see what the biggest risk to the markets is in the audience's opinion. All right, we got the AI bubble burst topping the list at almost half of the audience at 44%. We have another 29% worried about sticky inflation and central bank tightening. And then kind of a distant third, labor market consumer weakness, the old US midterm elections, we got 10%. And then in the something else, we did have someone submit that war could be a big risk. Definitely don't disagree there. It feels like geopolitics are a little bit all over the place lately. So Zach, I would love to hear from you. Do you agree with the audience? Is this AI bubble burst the top thing that we should be worried about, or are you worried about something different?
I'd say it's my top worry, Winnie, in terms of what could really shift this pretty stable environment that Logan alluded to, despite all of these shifting macro and geopolitical factors. I go back, you could maybe a year and a half ago, something to that effect. It was relatively short-lived, or even the SaaS apocalypse earlier this year. Both feel like fairly distant memories. And in general, I think the AI bubble truly bursting, if I had to guess, is that in the next year or more of a, call it 3-ish year event, I'd probably take the latter. But something like this, such a large shift in really the world, the technological backdrop, to think that we have any advantage in predicting that, I think would be short-sighted or misguided. So I do think that that's kind of the biggest X factor.
That's definitely a great one, Zach. Logan, how about you? From your seat across the pond, what do you think is the biggest risk to markets in the next 6 months or so?
I think it's going to be the technicals, which have been, overwhelmingly positive. And even if we see that sort of decelerate, that could put pressure on credit markets, particularly sort of the crowding out in the secondary market by heavy issuance. That's both governments and corporates. I think one thing that gets sort of overlooked is that the ECB is continuing to run off its balance sheet. By the most recent numbers, sort of on an LTM basis, we're looking at roughly 400 billion of debt securities running off the ECB's balance sheet per year. Also, the wind down of the ECB's corporate bond holdings, that's something like 50 billion per year. And so that net issuance has to be absorbed by public investors. So that's a key risk for me, as well as a potential rotation out of European corporates by foreign investors. We'll have a chart in our outlook going out tonight, but a large share of net buying of European corporates has actually been by foreigners. If we start to run into political volatility as we get into 2027, we have the key French elections taking place in next April. I think you're going to continue to see some decoupling in sovereign yield differentials, and that could potentially spook foreign investors to perhaps move back to their local currency debt markets.
Great. Thank you, Logan. I'm going to wrap it up. I kind of have three big risks, and they all work together. This year we have seen U.S. Treasury yield curve flattening and some dollar strengthening, and then we have the labor markets. Usually when we have yield curve flattening, it's not a great kind of forward indicator. While it doesn't necessarily mean recession, it is a little bit more of a difficult operating environment for financials especially. And then we've had the dollar strengthening, which could be a bit of a headwind to some corporate earnings over the course of the next quarter or so. And putting those things together, we've already continued to see some layoff headlines, mostly recently from Microsoft. And I'm really reminded of the last couple of years where the first 6 months have felt, pretty solid and strong and outperformed the back half of the year. And so when we have that combination of yield curve flattening, dollar strengthening, that does make me worried that we're going to add to some labor market concerns. All right, we are going to wrap it up in 1 minute because we do have one question on the Japanese yen and interest rates impact on the US rate market. Zach, what do you make of the recent moves in the yen market lately?
Yeah, it's interesting to see kind of USD JPY making new highs. When I think about the impact on the US rate market, maybe from a flows perspective, we are still seeing solid demand for U.S. Treasuries from abroad, and thinking about the hedging costs, which have really come down. They've been cut virtually in half over the past 2 to 3 years. And so when I think about that weakening environment for the spot currency, it's important to keep in context of the forward-looking rate environments in each. And if the Fed were to start hiking aggressively, I think those hedging costs would come up meaningfully and be a bigger consideration. But in the near term, with both the Bank of Japan and the Fed kind of appearing to have at least somewhat of a hawkish bias, those hedging costs kind of look a little bit more manageable and unlikely to completely wipe out that bid. That's how we're kind of thinking about that environment for now.
All right. Well, thank you, Zach. With that, we are going to go ahead and wrap up this Outlook webinar. Thank you, everyone, for joining us today. And thank you for a great dialogue in the Q&A box. We got a lot of questions. We got some comments. Always appreciate those. Good luck to everyone in the second half of the year. If you ever would like to chat with me or Logan or Zach, you can always reach out to us directly using the Ask an Analyst function on the CreditSights.com website, or of course by contacting your friendly CreditSights sales or client success manager. Enjoy the upcoming holiday and Taylor Swift nuptials, and we will be back in September with our next webinar. Thank you much.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast.
CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.